The US dollar resumed rallying, whereas the US dollar index has already hit a new 20-year high. Such a jump reflects investors' reaction to new whispers that the Fed will continue its aggressive monetary policy tightening to cap inflation. Traders suppose that the Fed will raise the benchmark rate by 75 basis points at the next meeting in September. The likelihood of this scenario is rising amid expectations of the US labor market data that will be disclosed tomorrow. The US Labor Department is going to publish employment figures for August. Notably, yesterday's report from ADP unveiled an insignificant rise in the number of employed people in the private sector. However, buyers of the US dollar focused only on the factors that may boost the greenback. Thus, they priced in the announcement made by the President of and CEO of the Federal Reserve Bank of Cleveland, Loretta Mester. She said that by the end of the year, the key interest rate might exceed 4%. Meanwhile, the European Central Bank is expected to raise the benchmark rate quite significantly. However, there are doubts that the Eurozone economy is ready for such radical changes. Inflation continues soaring, reaching one record high after another. The situation is also aggravated by the energy crisis. Economists foresee a faster rise in the consumer prices, which may force the ECB to take tough measures. At the same time, macroeconomic indicators are showing signs of a recession. Today, experts at the Market Economics have published final business activity data for the main Eurozone economies. The data turned out to be well below preliminary estimates. Thus, Germany's Manufacturing PMI declined to 49.1 points, whereas in the Eurozone, the same indicator slid to 49.6 points. Such performance reflects a worsening economic outlook amid lower consumer activity caused by high prices and interest rate hikes. The euro-dollar pair is still near the parity level of 1.00 despite the local activity spurred by the speculative interest. The price has been hovering within the 150 pip range for almost 2 weeks. In effect, this movement could be defined as an accumulation process. The recent attempt to consolidate above 1.0050 turned out to be a failure. As a result, the quote slid to 1.00. Under the current conditions, traders should not take knee-jerk decisions, since the trading strategy still depends on the main trend, which will be determined when the accumulation process ends. The upward scenario will become possible if the price consolidates above 1.0050 on the daily chart, not to confuse traders with the false touches. If the price settles below 0.9970 on the 4-hour chart, it may drop to 0.9900. However, a more considerable decline will take place if the price fixes below 0.9890 on the daily period. In this case, the downtrend will continue. In the UK, data on the Manufacturing PMI was ahead of projections. However, traders priced in the downward trend. The fact is that the indicator is still at the lowest level last seen in May 2020. Production, new orders and new export orders slumped, and thus leading to a halt in job growth and lower business optimism. Notably, the pound sterling has also dropped to the lowest level since March 2020, and the British pound has been gradually falling against the US dollar, and that's why the main downtrend is still in force. In this light, traders suppose that the price may slide to the local low of 2020, and the currency needs to cover just 150 pips to touch this level. However, the pound sterling is significantly oversold, which may cause a fully-fledged technical correction. The bearish momentum may fade away if the price hits the area of 1.14. 1.10 and 1.1525. How we're going to be in the short term on the financial markets, we will definitely tell you in our next news releases. Don't miss them and stay up to date with us. Subscribe to our channel and follow news. See you soon.